and we have these stalwarts of the profession and from the department to consider the panel discussion on the subject of digitalizing. Also, we have our architect of the conference who was there in the first session on innovation, and we have made absolutely and abundantly sure that he is also closing this conference so that we are well protected. Learned panelist, Shri Rohan Phatarphekar, Mr. Gulati, the moderator of the panel session, Mr. Vispi Patel, my president, Captain Sai. Friends, as you all aware, this is the last session and this is the panel discussion on transfer pricing. The manner of panel discussion will be explained to you by the moderator, Shri Vispi. And coming to the introducing the speaker, that is what has been interesting to me. You all well know about our panel speaker, Rohan Phatarphekar, who is a leader and leading in transfer pricing as a professional, and also he leads the transfer pricing practice of KPMG in India. During his tenure, right from the beginning when the transfer pricing was introduced, his firm is accredited for various recognition in India and abroad for transfer pricing practice in India. He is a global leader on transfer pricing, and he has experience of more than 20 years on taxation and transfer pricing since its inception on the Statute of India. Then we have Mr. Gulati. As you all well know, friends, he had been very kind to us, and he was also present as a panel speaker in the last transfer pricing course, and he has also obliged us this time. He is currently posted as a Commissioner of Income Tax Appeal, and he has been in this post for many years. And you all know, friends, the depth in which he analyzes the subject on transfer pricing. And I do not want to introduce my moderator, Mr. Vispi Patel, because I already introduced in the first session. And if I introduce now, he would perhaps not like it, that people have not forgotten him for last 6 weeks. So with this, I present you the panel, and I hand over the proceedings to Vispi to commence the technical session. And before that, may I request our President to present a memento as a mark of our love and affection, first to Mr. C.S. Gulati. Now to Rohan Phatarphekar. And last but not least, Mr. Vispi. Thank you. Vispi, my business.
my fellow panelist, Shri Gulati, my friend Rohan, and Yatin also there, and all the CPC members who take an effort to try and spread knowledge. I only try and contribute something here and there. I think what I can see is that everyone is very eager for these case studies. There is an impression that these 4 case studies won't run the time. So I leave it for your judgment. Let me try and see whether we can run it. Mr. Gulati may believe that we will run it. Rohan may believe we will not run it, but we'll try and see. It's not necessarily the quantum of time, but the quality of the discussion that takes place, the quality of the interaction which will create the necessary vibe, interest and other things. I think first thing I can see is that the atmosphere is going to be hot, and therefore I am going to take out my coat. Rohan may continue to wear it because I am no more part of the Big Four. He is part of the Big Four, so he has to wear it. That's the first thing I'm going to do. Fine. So now this is the way we'll take the panel discussion. I'll introduce the topic. I'll try and give a perspective of the topic. Then we will take Rohan's view, and ultimately we will take Mr. Gulati's view because it is a final view. And if I have got something to add, I will try and add. And Mr. Gulati has to have the final say, no? Because he was the Commissioner of Fields, he was part of the DRP, he's part of the DRP today. And I think most important, friends, is that he has always contributed to the chamber, because I believe that in life, you have to see everything in a holistic manner. You may not like something, or you may like it. You may dislike something. But the fact is that there is something on the table which has a different view. Is that view wrong? I don't think views are ever wrong. Law will get discovered. So what the revenue authorities believe, what the assessees believe, what the consultants believe, is of no matter, because ultimately jurisprudence will take its course and we will reach a finality in all these issues which we have in transfer pricing. And my belief is that we have not even touched the surface. 80% of the orders which I read from the tribunal, they are still on whether A is comparable to B or B is comparable to C. I mean, is that transfer pricing? And my answer is no, it is absolutely not transfer pricing. But before I get into that, if I get into the philosophical trait, I think then I will take 4 hours myself and then there will be a problem. So let's try and remain to the subject. Let's be focused on the case studies. I think the first case study is a very critical case study, because what has happened is, Mr. Gulati gave his viewpoint because he has been on the panel so many years with us, that we should try, we should try and make the case study which is practical, the problems which you face every day in our lives. Companies are multifunctional, companies do a couple of functions, carry out various business activities. How do you benchmark? And for that you require a case law, when the law itself is clear. But I mean, that's life, because the interpretation of the law takes time, because it's a new subject. So I think that in the first case study, what is important is, I will not give my view just now, it's not necessary, I'll just introduce the subject, is that there is an entity which does multi-dimensional activity. In one segment, there are international transactions, in the other segment, there are no international transactions, correct? So there is manufacturing and there is trading activity. What does the law enjoin us? And I think in transfer pricing, and probably my panelists will agree, and all of you will agree, there is a tendency amongst everyone, means all part of the same ecosystem, whether it be the assessee, whether it be the revenue authority who is administering the law, or whether it be the counsel who is trying to go there and give and perform his duty of trying to present the case. We can sometimes get lost in transfer pricing, because transfer pricing is embedded, lives and dies in business, because it is nothing else but an analysis of business activities. So in the performance of analysis of this business activities, you may sometimes get lost in the complete plethora of economic dynamism of the business, and you may suddenly believe that what seems rational, what seems economically correct is also legally correct. And therefore I have to just caution you on this particular perspective, is that everything that you do, right from analysis to the very end, the most critical part is that you have to still do what is enjoined upon you by the law of transfer pricing, section 92 to 92F. So whatever analysis you do ultimately has to be dovetailed into law, and you have to perform that analysis whereby you reach the arm's length price for the purposes of determining the income of the international transaction. So if you see section 92 subsection 1, I think there are 3 parts to it, maybe more, but the important part is there is income to be determined of the international transaction at arm's length price. So this arm's length price is this evolution of comparables and 92C and the most appropriate method and other things. But the important thing is that you have to still determine the income of the international transaction by coming to the arm's length price. So therefore, to come to the arm's length price, if you are a multi-dimensional activity taking place in your company, is it correct to do entity level benchmarking when it is possible to segregate the 2 activities to determine the correct arm's length price of the international transaction? And the answer is no. You have to determine the price, and if there are multi-dimensional activities, it is obvious that each activity has its own economic nuance. That means it has its own profitability, it has its own operating cost, it has its own way of functioning. So manufacturing it may be, a manufacturing activity may be more capital intensive, a trading activity may be more working capital intensive. So there are nuances to every transaction. So with this, I ask Rohan to give his view of whether the segmentation that was done by the assessee was reasonable, whether the arguments of the transfer pricing officer that the segmentation which was done is not as per the audited accounts. Is that the law? What is the law? Let's try and see how it has evolved. Rohan, your question. Thanks.
Thank you, Vispi. Before I get into the case study on the lighter side, I just wanted to mention that Vispi did mention about him removing his jacket. In fact, I would consider myself lucky that I don't have to, because at that time the revenue has a different view. And we have a different view because we have a job. The day the revenue and we have the same view, probably we will not have a job to do. So in a way, so that keeps everyone going, and that keeps everyone on the toes. So in a way, actually, it's good to have different views. So in this particular case, Vispi and presumably all of you have read the case study. Now, there are basically 4 transactions that we are looking at. The 4 international transactions that are there are import of raw material for manufacture of finished goods, sale of finished goods, which is a nominal value, IT support services, which is availed. Now, I am presuming here that the IT support service is only for manufacturing segment, because if it's in the case study provided that the trading segment does not have any international transaction, so it's there in the manufacturing segment only, and the volume of services also presumably is nominal, and then we have reimbursement. So these are the 4 methods, 4 transactions. Now, coming to basically whether the methodology adopted by the assessee was correct, I would feel that in a way that irrespective of what the audited statement contained in terms of the segment, from a transfer pricing perspective, it becomes imperative that the economic analysis is done as per segment in terms of the function, assets and risks. The manufacturing and trading activity is clearly, in this case, the trading is quite in terms of the percentage is pretty much 60-40 kind of a ratio. And I would feel that you have to derive segments from the economic functions, the trading separately and manufacturing separately. So to that extent, the approach of the company to go for this would be appropriate. The methodology that would probably be applicable in terms of the import of goods and manufacture. Of course, either you can use a cup or a transactional net margin method, or of course, I'll come to the cost plus method as well. Nowhere in the case study it actually comes out that there is a comparable uncontrolled price available, because we are importing raw materials, whereas in some case the company actually procures a finished product from the third party, so it's really not comparable. And I would say that a transactional net margin may, probably would be a better method. I'll come to the cost plus method also. The point is that the way the segmental has been done by the company is probably something that needs to be relooked at, because they have, while the cost of goods sold is clearly determinable, gross profit is determinable, the common expenses have been actually segregated on sales. Now that may not be an appropriate way to really do it, because everything cannot be segregated on sales. So there could be some HR expenses, it probably needs to be done on a headcount basis, and so on and so forth. So maybe that allocation of common cost, the allocation keys could be different. Also, what probably I would have done is that I would have got the segmentation verified by an accountant, so that there is some kind of validity and credibility to the entire statement. Of course, under the institute regulations, you can't really certify, because the whole idea is that it's ultimately an estimation of cost that needs to be segregated. But a verification of the fact that the keys have been appropriately applied, and it's to that extent it's been checked, that always gives a sense of credibility to the entire statement. Once you look at transactional net margin method, I would say that the IT support services as well as the reimbursement would also get covered. But having said that, there has to be, so one is on the aspect that, okay, your profitability can get tested at a net profit level, and everything ultimately will come, anything above that will come into this. But it is important in terms of maintaining robust documentation to really have a good documentation for, say, the benefits that you receive of the services that you avail. The need that really is there, or it's something that is basically standard agreement that is being followed. So to that extent, if you can maintain a certain amount of documentation to provide the benefits, the need test, also the evidence in terms of how the allocation, the IT services, the allocation has happened to the Indian company, that would be really helpful. Again, that would apply to reimbursement as well. So the more you have evidence in terms of the reimbursements that have been incurred, that would be helpful. But as I said, one is the net profit analysis, which would still, if you're okay, then everything would get covered. But I would feel that you have to have a secondary documentation in terms of really trying to see how you can do the benefit test and the need test and so on and so forth. Now, of course, one can look at, and ideally what would have happened is that you could have also looked at the gross profit level in terms of the cost plus. So one is this transactional net margin method, which I have already discussed, because ultimately at the level below the gross profit, all allocation of cost, and ultimately it's an estimation. But in the Indian context, what happens generally is that under the Indian GAAP, to get the gross profit of comparable companies is a big challenge. And to that extent is ultimately an estimation again that one has to do, because your depreciation, your wages, salaries, again, to the extent what really is the gross profit. So there is a challenge. Again, what would have happened is that if you had probably looked at the gross profit level, you again had the onus of actually benchmarking the IT services and reimbursement or whatever if at all. So there could be other challenges as well. So I would feel that overall in this particular context, a transactional net margin method would be probably an appropriate method. And of course, I have mentioned about the fact that the segmentation approach of the company was appropriate. But yes, it could have had been better in terms of the allocation keys being very specific. And to that extent, the allocation keys and of course the verification by the CA on the accountant on the entire segmentation, that would have been helpful. So that covered the question.
Rohan, only one point, whether TPO is right to reject the segmentation.
No, I mentioned that that segmentation is the right approach to my mind, and to that extent, the approach of the TPO to reject, because what the TPO is doing is actually doing manufacturing and trading segment together, which would mean that you are actually combining the economics of the entire two functions and the risks and the entire analysis of two functions which are different. And in this case, I can understand if the trading was 10% or something, but trading is quite substantial here. It's about 40%. And I would feel that just because the audited accounts don't contain a separate segment, I would feel a segmentation of manufacturing and trading is appropriate, and maybe the approach of the officer in that sense is debatable.
Mr. Gulati, please. Thank you.
Thank you, Ron. Thank you, Vispi. I think I'm going to agree to Mr. Rohan on quite a few aspects. I do not know by agreeing whether I'm going to eat into his job or his stability of profession. But then, having said that, I would say that yes, there are 4 international transactions. In the case study, it has been kind of mentioned that all the 4 international transactions are in manufacturing segment. Looks a little bit not so correct. Reason being, the reimbursement possibly cannot be purely stated to be of manufacturing. This is number 1. IT support possibly would be for the whole business, cannot be only for the manufacturing. To that extent, saying that these international transactions are covered in manufacturing segment would not be appropriate. And then, if that be so, possibly considering that only manufacturing segment and the analysis of manufacturing segment for benchmarking, by whichever method that we may agree to, either TNMM or cost plus or any other method, possibly will not benchmark the transactions relating to reimbursement and IT support in totality. So it leaves a small gap there. Second thing that I just want to say, that here in this particular case study, the import of raw material doesn't seem to be very significant, and so is the finished goods. Now, if that be the situation, it actually means one thing, that yes, the manufacturing segment of the SSE here in India is purchasing the raw material from somewhere else as well. And also, there are sales to the third parties. If that be the situation, I am sure there is some level of comparability available within the manufacturing segment itself. Because I would be selling finished goods to the AE as well as to the third parties, I do have a comparable available. This is number 1. Second, when I am importing not the all raw material from my AE, and it appears that there would be some purchase of raw material from the third party, I think there is a probability of some comparability available there as such. Third thing that I want to say, in the given case study, it has not been stated that the raw material which is imported from the AE is manufactured by the AE itself, because these companies are into manufacturing and trading of specialty chemicals, and the work profile or kind of a profile or business profile of the AE is not so much elucidated. But I would rather feel that any group company which is basically is into manufacturing and trading of specialty chemical possibly would not be manufacturing raw material by themselves. If that be not the position, possibly it will be a case where the raw material which is imported by the SSE in India is procured by the AE from the third parties in that country. If that be the position, again I have the comparability available. Now, I begin to say with that, yes, to certain aspects what Mr. Phatarphekar said, I am going to agree. And where I am going to agree, I am just listing them out. Yes, segmentation and segmented results possibly would yield better benchmarking, number one. Secondly, the reasons given by the TPO that the audited financials of segments are not available and therefore not reliable may not be very appropriate. These are the two aspects which I would say they go in favor of the case study and against the action if a transfer pricing officer is taken. But having said that, there is a third particular question which is very important, is that whether better analysis could have been done. Yes, there is a scope of improvement at all levels. I would say that even when it comes to IT support, I am sure a company which is there into the specialty chemical manufacturing and say, possibly the IT support services are not generated within the company itself. They must be resourcing it from third parties. They must be having a kind of a setup. And these IT support services must be provided to all the group entities across the world, not only in India. So again, going by the fact that these IT support services are provided, may be procured from the third party, possibly we do have certain platform available for benchmarking that transaction separately. As it is, possibly all here we would agree that international transactions, which are 4 in numbers in this particular case study, needs to be benchmarked separately and individually. That is what is the better approach mandated by Indian law as well as by the OECD guidelines. And I would suggest and feel that a greater analysis is required to be done in respect of those international transactions. More details are required to be collected, and a separate benchmarking of each of the international transactions would be required to be done. Now, coming to the fact that if what has been done by the SSE initially when he has taken the manufacturing segment and by taking the manufacturing segment, there is an analysis and benchmarking done by the TNMM. I would say and suggest, possibly when you look at the database available in India as on today, either you go for Capital Line, go for Progress or any other database, there is no company available in India who would be purely 100% into manufacturing. Of course, there are companies which are into trading segment 100%. Majority of the companies in India which are into the manufacturing would have a mix of manufacturing and trading, only the composition differs. The composition could be, here it is 40-60, possibly the companies that you see in public domain would have a differential composition, maybe 75-25, 80-20 or 90-10 or 50-50, whatever. So if that be the position, possibly what you took as a segment, a manufacturing segment, the comparables that you are taking are compromised comparables. Those comparables would not be 100% into manufacturing, and therefore the analysis which has been conducted initially possibly would be infirm, not so accurate, because in the comparables there would be some element of trading transaction as well, for which possibly you would not have details available in the public domain. If that be the position, again we come back to the position as to what would be the better methodology to do it. Again, I come back to say each transaction one should analyze separately, and I feel that in this particular case study, whatever details have been given, what they have not been given, do suggest that such comparabilities would be available. This is in short I would want to say. Open to the questions.
Sir, one question on this IT support services aware. You're saying that it has to be done separately. So how would you suggest this has to be done in terms of the fact that, given that, what I understand or what we can assume is nominal services?
I only would say one thing, when there is a IT support services, again we need to know a little more facts about it. If they are resourced from, say, third party, by the parent, by the AE, then possibly my job is much easier. In case that be not the situation, then possibly I can go in and do it on a cost